One of the biggest lies in our economy and our financial world happens to be one of the biggest threats to your personal finances overall. That's inflation. We're going to talk about what inflation is, but more importantly, I want to talk to you about a very simple but effective banking strategy that can help you actually combat real inflation numbers on a day-to-day basis without you having to do anything crazy with your money, but being a little bit strategic and being conscious about how you're spending and how you're saving your money. So I want you to stay tuned. Before we get into all of the context of this, I want to give you some background on who I am in case you're new to the channel. My name is James Phillips. I am a professional banker as well as 13 plus years in banking and financial services. I have an active life insurance license, active mortgage license, small business specialist, certified in small business, banking, cash flow, and lending, as well as a Series 6 FINRA investment license. So I've been all over banking and financial services for well over a decade at the time of this recording. As far as the context around what inflation is going to be the rising cost of goods and services. A lot of deep economic explanations on what inflation is and the source of it. But for the context of this video, you really just need to know that everything that you spend money on is just getting more expensive. I've shot videos in the recent past going over how inflation, or at least theories on how inflation got to where it is and some facts. But right now, for this context, I just want you to have a rough understanding of what it is in case you didn't know. More importantly, how it's the biggest lie and the biggest threat. Right now, the biggest threat to your finances being inflation is centered around the fact that everything that you're used to paying for is getting more expensive. And when you start to put context on the health of your personal finances, we all know, as much as we don't like the word, budget is key. Cash flow management is essential. If the cost of your goods and services are rising faster than your earnings, than your savings capacity, etc., then at the end of the day, that means that you're in a net negative every time you spend and every time you keep money in the bank. So that forces us into an environment where we have to take riskier financial behaviors on average to try to mitigate some of that loss to inflation. So think about the concept of inflation being one number and you having to go out and find financial instruments that pay you a higher number to try to stay afloat during this economic cycle. Well, that's the situation that we're in right now. And that is due to some government policies, that's due to some environmental circumstances, societal circumstances. Again, it's a pretty long story on how inflation got to where it is. But more importantly, the bigger lie aspect of it is the mainstream inflation numbers that you're promoted in the news and the financial media. To be completely honest, there's a lot of evidence suggesting that those numbers are deeply skewed by our own government, and the media is just parroting that. You also have an even deeper misleading component from the Federal Reserve and the financial media around the fact that inflation is projected to us in a couple, headlines, CPIs, PCE, these different mainstream versions of inflation that are taking into account entire baskets of goods and services, valuable resources in our economy. So they can be giving you a number that basically is an average out of every grocery store item that you can think of: meat, eggs, fish, fruits, vegetables, cereals, grains, etc. They can do the same thing with energy, oil, gas, etc., right? The moral of the story is that the numbers that they project to us are the ones that they are telling us that they are trying to get under control by getting them down to a certain number. We're going to say that their target goal is to get inflation down to 2%. The Federal Reserve uses a mainstream PCE or core inflation number that they like to gauge. And there's also a headline inflation number. If they're telling you that the mainstream inflation numbers a year and a half ago were at 9%, they've gotten down somewhere in the 3% range, 3.5% range, that's one number. What they're not telling you is that the specific items you might be spending most of your money on are higher. So yes, core inflation, headline inflation might be 3%, 3.5%, 3.4%, 3.2%, but you may be spending 10% of your take-home income on gas. That might be 6%. You may be spending X amount of your grocery bill on meat and eggs, and that might be up a combination of 6, 8, or 10%. This is not completely transparent on what you might be experiencing when it's brought in the news. So that makes it one of the biggest misconceptions, or in some cases outright lies, in our economic and financial system at the time of this recording. So what is a proposed solution that I'm giving you in this video? And that's going to be a simple concept that I've kind of floated behind in other videos in the past, and making sure that you are arbitraging positive returns when you spend and doing your best to capture that plus side and putting it somewhere that can earn reasonable interest without you having to do anything crazy to get it. What does that look like in more plain English? So I am a big advocate for credit cards as a financial tool. I think as a single financial tool, they're the most effective Swiss Army knife type of product or financial instrument in our economy. And what that basically means is it's one of the most accessible tools tools that the everyday person can get their hands on and qualify for. And oftentimes get really good ones that you don't have to pay for, that can help you build credit, that can help you budget, help you manage your cash flow, help you arbitrage your spending, meaning that you can start to get rewards points and cash back to offset the cost of the goods and services you're paying for. Better purchase protections, better fraud protection than using any other payment method that most of us would be using. This is paramount, because what this means is you turn around and take your credit card for the majority of your high spend categories, as I refer to. Think gas, think groceries, think your travel. Think about these other areas that, again, they don't talk a lot about, but might be inflated 5, 7, 10+% year over year for the last 2 years or so. And that's your higher spend categories and your discretionary spending. You taking credit cards and strategically doing your homework to either look in your current wallet or purse, or shopping financial institutions once you've itemized your higher spend categories and finding credit cards that will give you the best rewards points for those categories. From that point in time, let's just say you're able to get a card that gives you 3, 4, or 5% back. In some cases, you can get more than that if it's a particular bonus category or amplified multiplier. And you take that money, get it ideally in this scenario, this strategy, in a form of cash back. We're not going to talk about travel hacking in this particular go around. We're going to focus on everyday financials, personal finances, and let's just say you're getting those rewards points and cash back. Chase Bank is one of my favorite examples because they have some of the best credit cards in the game, and they have the simplest rewards point structure for earning and redeeming, even in my opinion, over American Express. It's very point blank simple to earn and redeem with Chase Bank's rewards points, ultimate rewards points. So let's just use that scenario and say that you're able to get your hands on a Freedom Flex, a Freedom Rise, and get yourself somewhere between the 3 to 5% category range, or particularly higher possibly in certain scenarios, and get that money back on your purchases that might already be inflated 3, 5, or 7%. You take that earning as you accumulate it, whether it be on a monthly, quarterly, or if you're the type to want to save annual basis. You cash those points in and you deposit them in a high yield savings account or a short to mid-term CD that is going to also pay you 3, 4, or 5% at the time of this recording. This is what I'm doing right now. It's one of my simple personal and small business. I'm doing the same thing on the small business side when I don't need those points for other reasons, like going to travel to record footage or film for my business, etc. I'm saving that cash back, cashing it out at a certain point in time, taking it, in my case, depositing it in my American Express high yield savings account, paying me over 4%. So I've gotten 3, 4 to 5% on this front end spending, and I'm coming back and taking that cash out and depositing it in a savings or a 2, 3, 5, 6, 8, 9, 10 month CD, earning 3.5, 4.5 to 5% at the time of this recording. This is an opportunity for you to legitimately take your everyday spending, use one of your favorite credit cards, or acquire a more applicable credit card. Take those rewards points. Don't just sit on the fact that you got those bonuses, those first year bonuses, welcome bonuses, and those amplified multipliers, etc. Don't just sit on that and then go turn around and use the points to go spend. No, take that money, turn around and drop it in a savings account or a CD. While interest rates are attractive, because they're not going to stay that way forever, I'm going to be covering a whole nother video, and I've been a little off on the timing, but it's starting to look a little bit more likely Federal Reserve is going to start pulling down rates, and I can assure you deposit rates will be coming down with it. Keynote on that, by the way, I've covered this in the past. As I start to wrap this video up, high yield savings accounts will come down first. So I actually think if you can afford 2 to 3 month CDs at your financial institutions, they're paying the better rates on those shorter term CDs because banks know those interest rates won't stay forever, so they don't want to be locked into them. And once you're locked in on a CD, they have to pay you that rate even if the interest rates come down on that same product in the future. Your grandfathered or contractually locked in. High yield savings accounts, interest rates are for that day and time. They can come down tomorrow. So if rates come down and you're in a high yield savings account like I am at Amex, I can go from 4.4 or 4.5 right now and wake up and be at 3.5 if interest rates go down to that point. Because as the Fed funds rate goes down, banks will pull their rates down with it in tandem. There's a direct correlation between those. So to wrap this little strategy up, I recommend you lean to the CD side if you want to capture those rates, even once rates potentially start to come down in the back half of this year or early 2025. But high yield savings accounts will suffice if you need the liquidity. I hope that made sense for you. I'm wrapping this video up. I want you to comment down below and let me know thoughts, questions, clarity, concerns, feedback, support for this strategy, kickback for this strategy. Comment down below. These are the types of financial strategies you can expect on this channel. If you're new, my existing pioneers are already familiar. We're constantly discussing financial strategies and tactics to make sure that we're optimizing our banking, optimizing our cash flow. We're bringing that to a higher level concept of doing better for our households, doing better for our communities, and making hopefully the overall society a better place. I am literally taking time out to shoot full out response videos. So if you're new or existing, comment down below. If you give a good comment or you leave a good question, I will cover it in a video. So other than that, to all my pioneers, welcome back. To my new viewers, welcome in. Thank each and every one of you. Support the channel by commenting, sharing, and subscribing. Easy, free ways for you to support this channel so this channel can in turn keep supporting you. Other than that, I want each of you to stay focused, stay in motion. I'll see y'all soon.